Hi, and welcome to Macro Wednesday, where we talk macro and try to make sense of markets that really don't make any sense. I'm your host, Steve Van Metre, and you know what? We're going to have some fun today because you know what, dollar bears? I ain't done yet. No. We're going to stir the pot some more today. But before we get there, I'll tell you why this is hilarious in a little bit. But we're going to have some fun today. But I want to come back a little bit to Monday's episode because a number of people sent emails. A number of people, sent me messages on Twitter, Facebook, in the comments. And just so you know, even though I don't always have time to respond to everyone or like everyone's comment, I do get caught up and I do kind of look through them because I do want to know what you're thinking about what we're talking about. And one thing that I found very interesting is so many people said, well, hey, Pelosi is going to pass a bill and that's going to make the M2 go up. Yeah, because Pelosi is also the Senate and the president. No. Look, it's not how it works. Just so you understand, the House of Representatives, they create a lot of bills. I mean, I'm not just saying this House, I'm just saying in general, the House of Representatives, they create lots of bills and a lot of them don't go anywhere. So in order for the M2 to rise, see, I want to challenge you to think deeper. Before you send some of these messages and emails to me, I really want you to think deeper. Is the government transferring money to people magically mean the M2 rises? No. Because what is the M2 telling you? What is the M2? It's savings. So let's just say the government gives you somebody $300 a week for a month. Does that imply that $300 gets saved? No, it does not. The key is government has to transfer money to people, and it has to be saved, and it has to occur in perpetuity, and it has to be more than what the Federal Reserve is buying in QE. It has to exceed the growth rate of the monetary base. It has to do all of those things. So until there's a bill passed, and even when there is one, and I'm pretty sure there will be, we still need to see the data of what consumers are going to do with it. Because remember, why did the M2 get built up? People were at home. They had more money, and they couldn't spend it. So what did they do? They bought stocks, paid off debt, and put money in savings. And they didn't have to pay on a lot of their debt because they put it into forbearance. And we do know, starting next month, that some of the government-backed loans are going to have, and again, I'm not an expert on which loans are going to do what. I don't have any debt, so I don't get to participate in what goes on with this. But what's going to happen is some of this government-backed debt, the 6 months of payments is going to go to the end of the loan. But you know what's going to happen to people who say don't have a government-backed mortgage, or maybe their credit card loans or car loans or whatever else they've got in deferment that isn't government-backed? It's called lump sum. 6 months payments plus the 7th is due. That's what forbearance normally is. It means we're going to give you a reprieve from paying on your loans. It doesn't mean that you get to take 6 months off. It just means we're going to give you don't have to make a payment for 6 months, but you're going to have to make them all at the end of the forbearance period. So why did people have to save money? Because some of those loans are going to start coming due again. So even if there is a stimulus, it does not imply the M2 is going to rise. Now, it could rise if people save it. But again, the whole notion of the M2 rising in perpetuity at a rate faster than the monetary base is rising implies right now that the government will have to continuously transfer money to people, make sure they can't spend it, keep their loans in forbearance in perpetuity, which the banks aren't going to allow, and make them save it. That's not going to happen. And we kind of already know from what is likely to come as a stimulus bill that not everyone that got it before is going to get it. So is it really bullish for the M2? It could be, but it doesn't mean it is. So remember, before you fire off some of these messages, take a moment and think a little bit deeper. Think back to what we're going over, and hopefully that will help. Now, the reason I was kind of laughing at the beginning of the show is because when Brent Johnson of Santiago Capital initially, the legendary captain of Team Dollar Bullish, very important, legendary Brent Johnson, Santiago Capital, reached out to me about the interview for Real Vision, which I'm being interviewed next Monday morning. I don't know when the show is going to air. They haven't given me any information on all that. He sent me a message on Twitter saying, "Welcome to the madness," or was it by email? Doesn't matter. And I said, yeah, I love it. I'm ready for it. And I don't think I think he had a good laugh about that because see, when you're bond bullish, you're like that kid at school that everyone, the people make fun of and laugh at. And I was never the popular kid at all. I'm still not today. So I know what it's like to get laughed at. So when you're bond bullish, everyone's like, when you're a dollar bull, man, you're the kid that other kids want to beat up at school. And that is what I wasn't prepared for. And it's great because today I want to stir the hornet's nest some more. Apparently there's some people that weren't thrilled about the interview on Palisade Radio. Some of you loved it. Many of you didn't like it. I've seen the comments. Many of you think I'm wrong. And you're doing a day-to-day count about, the dollar's down. Just so you know, as a macro guy, I'm bullish on something based on a longer time frame than 1 day or 1 week. And what's interesting to me about all the comments about, the dollar's down today, and maybe it's a joke or not, I don't know. But the fact that there's so many comments about that on the YouTube videos and in Twitter or wherever else I happen to be, it tells me that many of you have very short investing time horizons. It's like you're buying or selling weekly options. I mean, I'm a macro guy. I don't worry about weeks. Sometimes I need months, maybe even longer to play out. And you say, well, if you make such a prediction long ago, it'll happen. Well, the dollar bears don't think so. I'm very bullish on the dollar, and we're going to stir that hornet's nest a little bit more today because I think one thing you can appreciate is that I back a lot of my data up with facts and research that you can look up. It does not mean I will be right. Macro isn't about, this says this, I'm right. What it means is the probabilities of being right are increased. And when you're investing or trading or whatever it is you're doing with your money, and I'm not referring to putting it in the stock market, it could be in a real estate market, it could be anything. Could you just a decision to buy your first home? If you do it at the right time, where your probabilities of success are increased over probabilities of failure, i.e. buying high versus buying low, then you'll have a better outcome, or at least you have a chance of a better outcome. And that's what macro really is. All right, so before we get into stirring the dollar bullish pot a little bit more, I've got to talk about today's bond auction because, you know why? Hang on. I forgot something very, very important that we got to have when we talk about bonds. That's right. So you got to put on the crown and be the king. All right, let's get into today's auction real quick. Where's my screen at? $25 billion Treasury auction, and the market interpreted as weak auction. Now, what's really interesting, if you take these dollar amounts and divide it by the total competitive, you can find out the percentage of the take. And you can go on to my website, follow me on Facebook, Twitter, LinkedIn, and I post this stuff after market closes. So I track these percentages. And what's notable to me is they weren't far off from last month's auction, and the dollar amount was a lot higher. And, the market said, it was really weak. But you know what? If you get a decent offer on an oversized auction, that's pretty good. Now, some other data I'm looking at that I can't put on the screen is, you hear all this noise about, Steve, you're so wrong because sometimes I look at the image and realize how funny this looks. And we got, I forgot to mention, we got a cool new watermark. Thanks to my fans who helped make this happen. I've got some notes in the description if you're looking for a watermark. Excellent work. Very happy about that. And we got a new background banner. I mean, we're kind of upgrading this channel here. It's pretty cool. And thanks to all of you for pitching in and helping out. It means a lot to me. Everyone's talking about how the government isn't, or how foreign investors aren't buying up that much debt. Look, it doesn't matter. What matters is not T-bills. I don't care about T-bills. I don't pay attention to T-bills. I marginally even give a little bit care about them, okay? Just a little bit. And why is that? Because the large commercial banks and other entities like them need collateral. They need good, clean collateral, which are T-bills, and they're buying them. What I'm more interested in is when the primary dealers take 7.3% of the 30-year auction. Now, this isn't 7.3 billion of this is not the 30-year auction. And the Fed and over the next month, the Fed has to buy 10.5 billion of 30 years. What does that tell me? That they're 2.7 billion short of new issuance that the primary dealers could buy, flip entirely to the commercial banks that the Fed's going to buy. They're $2.7 billion short. Where's that going to come from? The market. So everyone's making a big deal. Oh, well, these T-bills and, the foreigners aren't buying it. Who cares? Who cares? You invested in T-bills? Probably not. What matters is the Fed is chewing up more of the long end of the curve than is coming out in new issuance. And what's notable about this auction, and I think someone mentioned it on Twitter, is, wow, the primary dealers look like they're really trying to soak up a lot of these auctions, almost as if they're crowding out the other bidders. Yeah, they've been doing that this month. It's almost as if the primary dealers need supply to feed to the large commercial banks. It really appears to be that is what's going on. And that's right, you heard that here first. Now let's talk about today's FOMC minutes. If you're not familiar with what the FOMC is, it's the Federal Open Market Committee, which is the Fed. And of course, everyone was excited because they were hoping for yield control curve. And I keep saying, they're not going to have it. Everyone thinks we need yield control curve, just lower interest rates. You know what? We don't. Where have interest rates gone since March? Almost nowhere. Maybe up a little bit. Maybe they're flat. They haven't gone anywhere. Why do we need yield control curve? We don't. Or yield curve control. We don't need it because we already have it. You know what quantitative easing is? It's a form of yield curve control. What does QE do? It causes rates to go down. All yield curve control is the Fed coming out and saying, hey, we'll buy all 30-year bonds at, say, 1%. And then whatever the demand is, they're all being bought at 1%. That's what yield curve control is. For some reason, the market, who thinks inflation is coming, this makes no sense to me, thinks we need to suppress interest rates, which would then in turn create lending growth, which would create more inflation. Do you know why interest rates rise in a debt-based economy like ours? To mop up extra currency supply. So when you have inflation, you want to see yields rise because it's confirming there is inflation. And those rising yields mop up and slow down inflation. That's what they're designed to do. So it's really backwards to me that everyone wants the Fed to suppress interest rates with yield curve control, and they're panicked about inflation. If anything, the Fed, if really the inflation was of concern, then why doesn't the Fed set the 30-year, put yield control curve and put the 30-year 6%? I guarantee you money will come right out of the market and right into the 30-year 6%. So what's troubling is a lot of people are running around forming opinions about things they don't understand, and yet it seems to be the popular opinion that everyone runs around with, and yet they really don't understand it. But QE is already a form of yield curve control. Let's go take a look at some dollar bearish or bullish stuff that I want to stir the pot with. So let's take a look at number one thing I noticed is people misunderstand how the dollar and quantitative easing work. So this inside the monetary base is total balances maintained at Federal Reserve banks. This is QE in blue. Trade weighted dollar in red. Hey, what do you know? When the Fed does a QE, the dollar tends to rise. When they slow down or reduce the pace of their balance sheet or contract their balance sheet a little bit, the dollar falls. When they do QE, it doesn't mean it happens immediately, but it can be a lagging effect. The dollar rises. And we zoomed in enough on this. Hopefully we are. And then you see the monetary base goes flat, dollar flattens out. Monetary base rises, the dollar starts to rise and shoots higher. It's still there. So what happened recently? Let's zoom in to give a better look. The monetary base went up due to QE. The dollar also shot up with it. And guess what? The monetary base started to contract a little bit. Why? Because the dollar swap lines and the currency swap lines and repo loans got paid off. So the balance sheet shrank a bit. Now the balance sheet is starting to bottom and rise. Everyone thinks the dollar's going to the toilet. It doesn't work that way. There's a nice relationship between the monetary base, quantitative easing, same difference here, and the dollar. Now, why is that? See, everybody thinks, oh, well, quantitative easing injects liquidity, and if they're printing dollars, which they're not, if they're printing dollars, well, then that has to be dollar bearish. It's not how it works. Look, QE is a swap in reserves, right? I'll be the Fed. You can be the commercial banks. I come to you and I take, say, some 30-year bonds from you in my forced buy. I take the money I'm going to pay you for them and I don't give it to you. I go over here to one of my Federal Reserve member banks under my purview and I park that money that I was going to give to you in an account with your name on it that says, if you come over here, you can't have it. The money stays here. It's a collateral account. You can't touch it. That money is held in collateral in case those bonds never come back. Now, what could possibly cause this, and I'm not saying this will ever happen, but if Congress were ever to wipe out all the debt on the Federal Reserve balance sheet, all that money held in collateral would come back out to the banks. Now, you had to go buy those bonds. I bought them off you and didn't pay you for them. Do you understand? How does that mean there's more dollars in the system? There aren't. It means there's less dollars in the system. Because if I buy something from you and effectively don't pay you for it, because I'm putting something in a collateral account that you can't touch, so it's not yours. You can count it, toward your reserves, but it's not yours. It's mine. You can't use that money to go buy more bonds. That's the point. You can't use that money to do anything. So you didn't get it. How is that dollar bearish? It's not. And that's why this chart right here makes a whole lot of sense. Because when the Fed does QE, they're not injecting liquidity, they're removing liquidity. And think about this. How is money created in a debt-based economy? Not by the Fed. When people borrow money. Now, do you think, let's do a little test. Do you think people, A, borrow more when interest rates go up, or B, borrow more money when interest rates go down? Right. They borrow more money when interest rates go down. So what is QE trying to do? Lower interest rates. What the side effect of it is it removes dollars from the system. Dollars that we desperately need. And everyone thinks it does the opposite. And that chart says, no, it does exactly what Steve thinks it does, or says it does. And it reduces liquidity and may not instantaneously cause the dollar to rise, but it will. It will lag sometimes. Sometimes it's rather quick. The more QE the Fed comes in and does as a burst, the more the dollar is sensitive to it. And you can see that down here in QE1, where it shot up, and you see it here. QE3, there was a lag. QE2, there was a little bit of a lag. And QE1 was right on the spot. So the next big burst of this rising amount of QE should put upward pressure on the dollar. Will it happen tomorrow? I don't know. Next week? Possibly. A couple months from now? I would imagine so. Now let's go on to the next thing everyone was saying was that, hey, I thought that when interest rates went down, the dollar went down. Okay, let's chart it. So I did, because most people don't do that. So here's a trade-weighted dollar in blue. Here's 10-year Treasury yields in red. Does it look like when yields are low, the dollar goes down? No, it looks like when yields are low, the dollar goes up. Maybe there's a better way to look at this chart. Let me invert it for you. And there you go. So what is it telling you? Hey, when yields are low, the dollar is strong. Now, why would that be? See, this comes back to me saying that there's that relationship between bond prices and the dollar. They kind of go together, but sometimes they've got those jaws where they're split apart. What do low interest rates tell you? Financial conditions are tight. What does a strong dollar tell you? Financial conditions are tight. So right now we have a relatively weak dollar and low interest rates. So the bond market is saying financial conditions are tight. The dollar is saying financial conditions are loose. One can only be right. So what is the Fed doing? Is it buying dollars? No. The Fed is buying bonds, which will drive interest rates lower or keep them suppressed. Pick whichever one you like. And they're removing liquidity or dollars from the system by doing QE. So the highest probability outcome is the dollar will rally. So the notion that low interest rates cause the dollar to weaken is false. Now, low interest rates will eventually lead to a weaker dollar. Eventually. I didn't say overnight, didn't say, a week later, but why is that? Because when interest rates are low enough, what does it do? People go out and borrow. And when they start creating those new dollars and those dollars get into the system, what does that do to the dollar then? It makes the dollar go down. Get it? Cool. And that's why if we look at a chart, and here is TLT, bond prices, and we overlay, say, $DXY, what you normally see, and we've looked at this chart before, is there is a relationship with them. Look at that. You can see. So right now, if we zoom back in, you can see and I'll change it from purple if it helps you. Dr. Purple is always happy when we use his name in the show. What you see is right now the dollar is headed down and bond prices are relatively high. There is a gap. This gap will need to be filled. The question you have to ask as an investor is, what is the highest probability? Are bond prices headed lower and interest rates headed higher? This is what the market believes. Or is the dollar headed higher along with bonds because the Fed's buying bonds and pulling liquidity out of the market even though they claim they're adding liquidity? I'll let you decide because you already know my answer. It's printed right there up on the crown. I'm Steve Van Metre. Thanks for joining us today, and I'll see you back on Friday when we can look at the credit data. Guess what? Will tell us there's no lending growth and no dollars being created, and somehow that's still dollar bearish. I don't get it, and you shouldn't either. I'll see you on Friday. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recognition or solicitation by a security, financial product instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.